Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Mark Travis, President and CEO of Intrepid Capital, to discuss diversifying away from the handful of well-known companies driving the equity market this year. Mark, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill. Glad to be here.
And let's talk about that concentration risk that we're seeing in ththose handful of names where they're calling the Magnificent Seven, Magnificent 11. We all know which these names are. In this case, though, we have to be careful with emotions not dictating investment policy. How concerned are you about that concentration risk?
Well, again, I think I've relied on Dalbar and Associates out of Boston, Jill. They've done a lot of work looking at fund investors' returns and how poorly they time things. I'm a concern when you've got the magnetic draw of the Nasdaq index up probably 20-something% year to date, that people are going to wait for it to reach a new high before they add capital. Not that they shouldn't have been exposed, but there's so many other parts of the market that could add to that and maybe give them a better risk-adjusted outcome. And that's really what I was going to talk about.
Well, let's talk about that. Where would you look to expand your capital? Where would you put it?
Well, I think as rates have risen, it's certainly a compelling argument away from the equity market. Again, everybody I know is concerned about the next move, June 13th and 14th of the Fed, and a higher discount rate does lower the present value of a cash flow. And there's plenty of companies that have cash flows well out of the future that could be impaired by higher rates, but it hadn't slowed them down so far. And we've moved over 500 basis points the last 14 months. But if you look at the short duration high yield market, you've got a high yield index probably with a cash yield of close to 8.5, 9%, which is pretty close to a long-term equity return, and you're higher up in the capital structure. So as I like to say, the bankers get to eat first. Well, the bondholders get to eat before the stockholders. So that's an interesting area. Again, it's been broadly broadcast. You've now got short treasury rates, over 5%. That obviously won't last because you're only committing to a, 3 to 6 month maturity. But that's certainly a market improvement from what we've seen in the last decade with the rate suppression activity that the Fed's engineered.
So if you were to look at different asset classes, let's focus on equities for a moment here. You think that there's opportunities in small caps. If that's the case, what market cap would you be looking at, and what else would you be looking for on the balance sheet to feel comfortable deploying capital in some of these names?
Well, I like kind of small to mid cap that really, if I can find a combination of ideally a family that founded a business that owns a significant stake. There's a fine line between enough of a stake and too much of a stake where they can control you and have their way with you, so to speak, which I obviously don't like. You often find two share classes. I don't want to totally rule out two share classes, but most importantly, I think it's the balance sheets of these businesses that's really the most attractive, where they run it like a private business and they build them to last. And they generally have a lot of cash relative to any liabilities on their books, which, let's say financing rates go higher than people think at the moment. I'm not saying they are, but, if they did, these unencumbered businesses that are, 5 billion to 20 billion equity market cap sometimes have $1 billion to $3 billion in cash that helps them kind of ride out the storm, so to speak. Again, not that I'm predicting either higher rates or a storm, but we do have periods where it's nice to have your own liquidity.
What about opportunities in fixed income?
What about the opportunity in fixed income?
Yes.
Well, again, I would probably, the Treasury bill market certainly has been broadcast with the demise of Silicon Valley and a few others. There's been a disintermediation between banks and now the short part of the Treasury market. So for people's cash, that's a very reasonable and nice, attractive short-term return. For other investors, you've now with this move in rates, like we just talked about, we've pretty much, we've erased 5 years worth of fixed income returns, and annualized rates are somewhere in the 1.5% to maybe 2% range. But now you've got corporate short credits, investment grade, high yield that, again, approach equity type returns. So for at least a portion of a client's portfolio, that should be something they should consider, in my opinion.
All right, Mark, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.